Hey everybody, this is Jim at SP500chart.com. It is 4:10 here on the East Coast on December 19th, 2013, and we're going to take a look at the S&P as we do after every day's close. I want to thank you for bearing with me for the past couple of weeks while I've been doing a lot of travel. Fortunately, I've figured out a pretty decent way to get these things done on the road. It's just not quite as nice as what I do here in my office. But anyway, let me read this to you, then we'll get a look at the chart. www.sp500chart.com and this video are for educational purposes only. Nothing stated at the side or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research, and please make investment decisions that are suitable for your personal financial situation. Who was it? One of the famous Greek philosophers says, "To thine own self be true." You've got to know what you can tolerate, what your risk level is. You got to learn what works for your personality, and what works for person A may totally screw up person B. But even though that's sage advice, I got to remind you that I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's take a look. Okay, the first thing I'm going to do is a little different. We are looking at a daily chart of the S&P, and it's nice to do this and everything, but I discovered something that I want to show you that's a little bit different twist on the traditional Japanese candlesticks that we use in these charts. And what it is, I'm going to teach you two Japanese words. Heiken, Ashi. I don't know if I'm saying those exactly right or not, but that's my best estimate of how you say it. Heiken, Ashi. Two words. Heiken means average. Ashi means pace, I believe. It could be backwards. But what it means is an average pace. And if we switch the traditional Japanese candlesticks over to what are called Heiken Ashi, which you do by using the edit chart settings right here, go to plot style, and where it says candlestick, go to Heiken Ashi. And I want you to watch how this chart looks a good bit different when we do this. Okay? Let me throw this over here. This is a really interesting. If you do the Heiken Ashi candlesticks, this looks so much, to my eyes, looks to be so much clearer where the trends are. Let's go back to the traditional here, and then the Heiken Ashi. I'm just kind of experimenting with this. Now you might say, well, what's the difference? Well, it's not extremely simple to explain briefly, and I don't want to go into too much detail. But the numbers are different. For example, with the Heiken Ashi, we closed today at 1807.59. But if we go to the regular candlesticks, we closed at 1809.13. So what's going on? Well, it's just a different way of calculating the close from an average of from the low, the high, the open, and the close. So you kind of smooth out some of the noise in the markets by using that Heiken Ashi. The other thing is your opening price, your closing price is based upon the current day's open, close, high, and low, but the open will be the average of the real body of the preceding day. Okay, enough on that. Let's go back. We'll leave it on candlesticks. I just wanted to share that with you because a few of the stocks that I trade in, really the chart seems to clear up a good bit when you go to this interpretation of the data as compared to the regular traditional candlestick. But we'll go to the traditional candlestick because that's what we've been using forever and ever. Well, today, yesterday we talked about this really swift move that came off of the lows of the day when the Fed made their comments that interest rates would be kept very low. What are interest rates now? It takes a well, never mind. Very, very, very low. And as a matter of fact, when that news came out, the S&P made a 40-point swing in the matter of about 2 hours. About 2 hours. Now, today, we had a little bit of weakness to start off. We stayed above 1,800, but the S&P really seemed to want to challenge this upper line, and I think that's a sign that even though the deed isn't done yet, even though we're not over this line, the way we came down and then attacked again and then stayed right at this level tells me that the S&P is at least wanting to make a good faith effort at breaking this line. Now, what would happen if we were to fail to break that line, and maybe we come down back to this neckline, find support there, and then come back up? Let's just pretend like maybe we dip down here and we come back sometime right around the end of the year or right around January 1, we may be looking at, to confuse things even more than they are already, we may be looking at the formation of an inverted head and shoulders forming, strangely enough, right after what appeared to be a head and shoulders top. Okay, it's happened before. This did look like a head and shoulders top. And I think we made the right call when we saw that. But when it failed to behave properly on the breaking of that neckline, and when we got that big bounce yesterday that calls this whole thing in this blue box into question, and we may end up having to evaluate something inside this blue box. Just saying, you can't know for sure until you get that technically significant breakdown of the pattern. This appears to be a head and shoulders pattern that got saved by the Fed. So, as we look at this in a little bit more detail today, and by the way, remember we were talking about this orange line here, that once the S&P gets over this orange line, to be on the lookout for a challenge of the previous highs that were set, and we're right there. I just had no idea, and I don't think anybody could have had a rational expectation that we would see that move within 2 hours. I would have thought it would have taken, a couple of days, best case scenario, if you're a bull. But if we zoom in a little bit more here and we take a look at what we saw develop today, we can draw a couple of small trend lines. We can show you, for example, clear resistance right at about 1810 roughly. I think we can call it 1810 and be close enough with it. Make that light blue. And I don't know where our next short-term low might be, but we may be dealing with the formation of a little flag here that could be, after that straight run up, now we consolidate sideways, and if it is a flag It could be a bull flag, and if it's a bull flag, then we could very well be looking at that flag flying at half-mast, taking us to that 1840, 1850 area in the days ahead. Obviously, before we can expect that, or before we can have any chance at that, we got to take out 1810. So this appears to be a new short-term resistance line, which is not that different from the resistance line that we're dealing with from the last two tops. So really we're caught up right now in an area of resistance, but what looks to be an area where this could be a breather. You know, if we do fail here and then we come back down, then I would look to probably this line here for support. That would be the neckline of our failed Head and Shoulders top. So if we come down and bounce here and then come back up, we would be dealing with an inverted Head and Shoulders forming off of what is between these two orange lines, what would effectively be a bull flag. So guys, right now, I would just say, let's see if we can power up over 1810. If so, I think 1840, 1850, something like that, could very well be in the cards. We do have a couple of trend lines to extend that could come into play. So let me extend those now. But, you know, we'll evaluate if and when we get up to these levels. Right now, straight line, today, sideways. Certainly, I think a reasonable outcome from that big 40-point move yesterday. I wouldn't expect us to put on another 30 points today. Instead, we're down a little bit at the open, down by roughly 10 or so, but then we recovered to close down very marginally. So guys, there's your video for December 19th, 2013. Thanks for watching, and thanks especially for your support.